In today's video, we are diving deep into Uber and Lyft and why, for some reason, the market loves to be doom and gloom on rideshare companies. It doesn't make sense to me, but we're going to dive in. My name is Chill Trades. I use my 12 years of experience to help you understand what's happening in the markets. So let's dive into things because I know this video is going to be long. So we're going to cover three main things today. The first one, should you love or hate rideshare companies as an investment? Is the news true? Like, is automation going to kill these companies, or is there an opportunity when others are fearful? Were they going to hop into their most recent Q4 earnings as well as 2024? We're not going to do a deep dive on like the financial sheets, but we are going to kind of look over what they presented and see if there's some positives or negatives in it. And last, technical analysis. Let's look at the charts and see where these prices could be headed. Before we hop into things, update on the portfolio. We're having a killer portfolio this year. These are all year-to-date positions, except for that 100%. That's a more long-term holding I've had for a bit. We're killing it this year. So I'm figuring out ways to bring you into this. Maybe I'll do some Patreon things or something. I'm working it out. But let me know, do you want me to do a Patreon? Something that's maybe a few bucks a month and you get access to the investments that I have? Let me know in the comments. Okay, rideshare. Why people hate on them. We're seeing all this news out there that Tesla, Waymo, or any other potential solutions are going to destroy Uber and Lyft's dominance. Is that the case? Should we be concerned? I personally believe what is not being considered, which is like the biggest elephant in the room, is that how people travel is going to change drastically as the prices of travel declines. And so like we just know that ownership's going down. Maybe it's slow right now, but it will continue to accelerate as we see technology, AI, automation, robotics start to pick up more. These companies are severely going to benefit from this. The dream of our parents, of our grandparents, is not of this generation. 2 to 3 cars, own a house, have 2 children. That is not the dream anymore. And so kind of talking about this convenience generations, this next wave of automation with AI and robotics, it is going to change the way we function in society. And these companies are going to directly benefit from it, not lose, because a couple companies like Tesla and Waymo are doing things really innovative right now that Uber and Lyft will be a part of. So let's go kind of into the demand. So kind of just looking at some research online, Americans say that by 2023, a third of them will ditch cars. Guys, right now, car ownership is like in the low 90%. It's like 90% of people own a car, either ownership or leasing. By 2030, that's 5 years, guys. A third of them say they'll consider ditching a car. Imagine in 5 years what the cost of driving in an Uber is going to be. We're going to get to that in a second. But right now, it's like $30 for a ride to the airport or something. Just wait till automation takes over and you're paying $8. Are you going to own a car? We're traveling less, right? On a day-to-day basis. People will continue to work from home more. These things are going to happen over time. And so people are going to own less things, since cars is part of that. Looking at another article, very similar. Private car ownership will drop 80% by 2030. Private car ownership. The number of passenger vehicles on the road will go down drastically by 2030. This is 5 years away, guys. We're in 2025. This is 5 years away. The last one, using electric ride sharing will be 4 to 10 times cheaper per mile than buying a car. This is 2021 is no longer as accurate, but just think about in the future what's going to happen. You're paying $600 a month in a car payment or something, and you can actually just ride share when you need for $100 a month. Guys, this is going to change the way we travel, and the market share is going to grow drastically. That's why this third graph is really important. This is another thing I saw about from 2022 to 2023. It says 72% of people are not users of rideshare. 72% of people. So we're saying that with Uber growing this big, with Lyft growing this big, with Waymo popping up, Tesla, we know they're going to do something. Right now, there is 72% of people who can still use this service more often or potentially for the first time. The demand will outgrow the competition in this space. I promise you that it will outgrow it. Next thing, driverless rideshare will destroy Uber. That is the biggest false statement I've ever heard. Something that Uber presented on their earnings is just showing the price per mile as they kind of innovate in their business. And you know, we think of like $3 to $4 per mile, getting under $1 per mile. Prices will go down so far that everybody will use it because it's cheaper, like I just mentioned, than a car payment. This will continue to happen, and the prices will continue to go down. We know that technology is accelerating at such a point that we will see this within the next 5 years. Prices will be at that $1 mark in 5 years. The second thing is, I think there's been this talk that like Uber and Lyft are going to get destroyed by automation. These guys are partnering with everybody. They own the keys to the rideshare economy. And so it is going to be extremely beneficial for tech companies to partner with them because they own the keys. And that's what we get to hear a little bit. It is going to be extremely hard for businesses to get past regulations on high percentage of automated vehicles. It is probably, I would say, at minimum 5 years away till there's a significant number of automated AV cars on the road. I promise you, this is not next year. This is not the following year. This is 5 years, 10 years. We're maybe talking about a large percentage. And what we got to realize is Uber and Lyft are the gatekeepers. These guys have the networks. Their networks will continue to grow as the market expands. And building out the network and system complexities to make something like this function, Uber and Lyft have been doing this for years now, and other companies are just getting into it. They own so much proprietary information about how this works that companies will have to work with them. It's not if you want to work with Uber and Lyft, you are going to have to, because of the years of learning, the years of building out these networks and systems are going to be extremely valuable to everybody else trying to get into this space. And that includes Tesla, and that includes Waymo. Now let's get into earnings a bit. So we're going to start with Uber. I mean, I love their earnings. When I saw their earnings, I posted a video. If you're not following the channel already, please do. I'm doing shorts to keep everybody updated on the market. Amazing growth. Two things I want to highlight here. Uber is becoming a profit machine. A profit machine. For years, they were growing. They were spending a bunch of money, not making a ton of money, or even negative, so not making any income, on the balance sheet. They are now making it rain. Adjusted EBITDA, 60% year over year, guys. In 1 year, they increased their EBITDA 60% when everyone's been talking it's a soft economy. It's a soft economy. It's a soft economy. 60% EBITDA growth? That is absolutely insane. Free cash flow. I'm telling you, money makers. 106%. Why free cash flow is so important is because they are going to have to invest a lot of money in innovating. Like I mentioned before, with AV, with robotics, with AI, they are going to have to make investments via partners or themselves or a mix of both, and that's going to take a lot of money. And so it is the perfect time for Uber starting to print a lot of money because they're going to be able to reinvest this, whether it's in themselves or partners or investments in other companies in this space. And this is extremely important for the future of this company, that right now they are becoming really profitable and they can spend that money to grow more. Now let's go into consistent growth. What's so amazing about the Uber business so far is they've been extremely consistent. And even at this maturity of the company being around for a while, look at this consistency. 22, 20, 19, 16, 18. We are seeing consistent growth on a quarter, and a yearly basis. That is extremely bold. That means, and it shows us to the points earlier, that this market is continuing to grow. More people are booking. More people are becoming comfortable with ride shares as we're on the edge of going towards automation, AV, robotics. Again, a lot of people do not use rideshare, and over the next 5 years, that market is going to expand substantially. Next thing, the food business. People forget that Uber has a food business that makes a shit ton of money and that is growing substantially as well. Look at these numbers. Gross bookings up 18%. Revenue up 20%. Uber is not just a ride-sharing company. They also have this second part of the business talking about a convenience generations. Ordering food to your house will become more and more and more normal. Eating out at restaurants, that kind of thing, cooking for yourself. These things will continue to decline as technology and robotics increases, and Uber will be the beneficiary of this, guys. Automation is the greatest thing to ever happen for the Uber business. It is going to increase their margins substantially. Demand and markets and TAM is what we call it, total addressable market, will continue to grow, which means this company's revenue top line will continue to grow and their bottom line will continue to grow. Now, kind of looking at my own kind of sheet that I keep track of, there's three main metrics I like to keep track of for companies, kind of around this size, a little bit larger: EPS, return on equity, and price to earnings ratio. And this is, Uber gets a lot of check marks. Check, 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 check. Let's look at this. EPS growth for Q4. I mean, look at this, guys. They are becoming a crazy profitable business. They figured out this thing. They are the winner in the market, right? Like, we know Lyft has not been able to keep up with them. Lyft is number 2, which is not a bad thing, which we'll get to. Extremely profitable now. Return on equity, 141% in Q4, 56% in 2024, guys. When you're looking at companies at this maturity, you want to look at two things. What is growth rate? If a company can hit at least 20% growth rate and have an ROE at least 20 to 25%, this company will continue to trade at premiums. And that's when we get to PE, a 28. This company is still way too cheap for the profitability and the returns that it is giving to the shareholders, as well as top line growth. So companies still too cheap. And I'll chat about that a little bit more when we get to the technicals. The last thing I want to cover for the business is that they have a ton of investments. Like, through the years and using capital appropriately, Uber has reinvested money in other companies in the space. Some of these companies are international. Some of these are just in the US. But they are making the right investments to then use that, like I said, printing money. They're using that printed money to then go also invest in others. And so these equity stakes at almost 10 billion, these will continue to help the business multiply and grow, which at some point will become more, will eventually mean that they're going to start buying businesses. This will happen. And that will also be an important part of them staying up to date on the latest and greatest in technology, is acquisition will become more of a strategy for Uber. So I'm surprised they haven't just bought Lyft already, but maybe it's nice to have a second competition that grows the market. Let's go into Lyft. Lyft is a tiny company still, market cap. They are in a different universe than Uber in terms of how small they are. But Lyft had an amazing year. I personally am a Lyft driver, but now that I am investing in Uber, I need to become a Lyft driver, a Lyft user. But now I need to become a Lyft, Uber an Uber user as well. But amazing growth. Just look at this, like record numbers, record growth in bookings. I think a lot of people were concerned about Lyft over the years, but I think they've made some really strong and strategic adjustments. Ride shares took all-time high. First year in company history that they are profitable. We're going to hit this point in a second. Adjusted EBITDA, gross bookings, margins. We'll talk a little bit more about that. There's some concern there. Free cash flow. We want to invest in companies that can support themselves. We don't want to invest in companies that have to issue shares to raise money, have to continue to go out and do private fundraising. Like, these are things that we want to avoid. And so Lyft now being a free cash flow positive business, being able to make money themselves with the business they've created, is extremely important to make it a more viable investment. Kind of similar to what I said with Uber. They now need to use this money to grow and innovate the business. If they can do that well and thoughtfully, I don't know if they necessarily take share from Uber. but they will stay in the game is what I'll give to them. You gotta realize not every company has to become an Uber. You can make an investment in a company like Lyft and it can still be really beneficial to your portfolio, especially when I believe they're undervalued. Q1, I want to look at guidance a bit here. So gross bookings, again, 10 to 14 growth, that's decent. I would like a little bit more than that, honestly, but that is not bad. I don't know if you hear that in the background, but I have a wild creature in my house. It's called a child. Adjusted EBITDA, again, on the point of making money. They are now a profit-making business. It's really substantial to make this a good investment. Adjusted EBITDA margin, 2.5%. Again, that's still really low. What makes me nervous about Lyft is that if they have a couple bad quarters, they're now pushing back into not a profitable company, and that makes me a little nervous. And we'll get to that on this next part. Couple of things to highlight on the mixed financial sheet. The first thing, growth rate, 31% year over year. I love that. I love getting that, reaccelerating that growth. 2023 was a bad year. 2024, we are on good momentum heading into 2025. Second thing, like I mentioned, gross margin. It was very, very low, so just profitable. We saw Q4 is a little bit more profitable. I want to see this increase a bit more. I am nervous that they will not increase profitability enough that if they have some negative quarters of not making any money, that is going to really hurt people wanting to invest in this company. Lyft has to prove to us that they can make money as a company and they can continue to grow revenue at this rate while making money. That is going to be really essential in this age of investing in stocks. And the last thing I want to hit, ROE, I already talked about that. I like to see ROE more positive. I do believe that we can potentially get there this next year, but that's something we want to keep an eye on. And then last, forward PE is just too cheap. This company, now that they're profitable, growing 26% Q4, 31% in 2024, that is way too cheap. 12 multiple is ridiculous. If I'm still being conservative, maybe a 20 forward PE with some of this uncertainty, but that is way too cheap now that they're profitable. And lastly, let's do a little summary. Demand will continue to grow. I want you to remember this. Demand will continue to grow, and that will outpace the competition. Growth will outpace the competition. There is plenty of opportunity in this market, plenty for many people to win, and Uber will continue to be one of those main winners in many ways. Uber and Lyft will adopt AV, guys, either by themselves or with partners. They understand that this is essential. They understand this is the future. They're not going anywhere. It's going to happen. And now, like I said before, they have the network, they have the infrastructure. That's extremely important for them to be successful. The future is convenience, and these companies will benefit, whether it's food for Uber, whether it's ride sharing and the ownership of things going down. The convenience factor will make these companies extremely beneficial. Convenience of what we want as humans, convenience as AI and robotics start to play a bigger part in our lives and doing less in some ways. These are the companies you want to be invested in. These are the companies of the future. Let's get to the charts because we're already 18 minutes in. That's insane. Okay, I just did a longer video on Friday breaking this down a little bit more, so you might want to go watch that video from last week. And the price change hasn't changed much, so the story's pretty similar. But to recap some of it, we were in this kind of sideways pattern for quite a while. We broke out in this really bullish period for Uber, came back down, and it's really positive that it hasn't broke below this kind of price, this price cycle, I guess is what we'll call it. Coming down and testing it, I bought down here at 60 recently, be transparent, and now we're back at 80. I think I'm up 35%. We have to break out of this. What I am looking at is RSI is getting a little overbought here, right on the edge. So this company is going to have to cool out a bit. Basically going from 60 all the way to 80 in a month, 35% in just in 2 months. That's way too fast. This one's gonna have to chill out a bit. So thinking long term, we have the 200-day here. 200-day is, let me move this a little bit. 200-day is right out the support at 70. I don't necessarily want this stock to go back to 70. That would make me not feel as excited. but finding some more support here, you know, maybe at the top of this to create, mentioned this in the other video, creating a slightly more inclined, or even if it kind of chills out here for a while, you know, like I don't mind it chilling out, maybe not till May, but chilling out a little bit here and showing me like I'm ready to boost off again. But this is extreme supply, guys. So much supply here. What supply means is as price gets back there, there's a lot of people who are selling now because they've been holding stock since March 24. And now they want to get out of it. Some of them got it out of here. And now there's more people here saying, okay, I bought this stock at a peak. I want to get rid of it. I'm tired. I want to move into other positions. And so there's a lot of supply we're selling through. And that's why we're kind of stopping here. But this is showing a lot of positivity. 200-day starting to try to move back up. If we see the 200-day start to accelerate upwards, that is a positive that we are in the next bull run. Like I mentioned, this stock is still undervalued. I honestly, in the short term, maybe in the next 3 to 4 months, $100 price target. Long term, I think this is like $150, $160 stock. But we'll get to that in future videos. Next stock, Lyft. This chart is obviously a lot different. Let's zoom out a bit. You know, it was up there, up there years ago, and it's been in this downward spiral. But a positive here is we're getting towards the top of this range. And look at all this accumulation. Guys, accumulation is the most powerful thing in the market. We talked about this in other videos. Sideways, 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 sideways. What happens in sideways patterns is people are buying. There are people who are selling, but people are buying. And if we break out positively out of a consolidation period, that creates additional positive momentum. If we're in a really long consolidation period and we break below, that typically means a lot of sellers start to happen. So we are creating, I would say, an okay uptrend here. RSI is healthy on the daily. I'm not really going to call this much of a trend yet because not much has happened. But we are kind of having like a sideways triangle a bit here, these two red lines. I don't think it's that strong of a pattern. More than anything, the stock has to get above that $16 price and hold. So I don't mind this creeping up a bit more here and then making a decision. August is way too late. I'm not going to hold a stock till August. That's going sideways. But I want to see some positive action here. I want to get out of this sideways triangle. I'm not holding Lyft to be transparent, but I am watching it. Just so that I might decide to own both Uber and Lyft at the same time, just to play both parts. But this is still kind of sideways. One of the really big positives is on earnings. It sold off to $12. And you see this extremely large candle. That means a bunch of people hopped in on that move lower. We've seen a lot of institutions move in this stock over the last 3 to 4 months. And so we know these shares are being gobbled up by large institutions. I'm saying like multiple percentage points ownership in this company. And so I'm currently just watching this, seeing what's happening. It's trying to get above this 200-day. It's trying to hold support there. But I have no desire to hold a company that's going to move sideways for a long, long time. But I do feel optimistic about rideshares and where these companies are going. So that is my perspective on rideshare. That's my perspective on Lyft, on Uber. Let me know yours. Thanks for watching this whole video. If you got to 25 minutes, crazy long video. Got to make these a little faster. But till next time, succeed in the market with me.